All right, let's dive into a financial tool that went from being, well, an outlaw tactic to a trillion-dollar titan of the corporate world. This is the story of the share buyback, and it's a heck of a story about transformation, controversy, and a whole lot of money.
I mean, think about this. 100 years ago, if a company bought its own stock, people would call it market manipulation. In a lot of places, it was flat out illegal. We're talking major economies. The UK, Germany, Japan, they all had bans on the books. Now, fast forward to today, and corporations are spending trillions a year doing that exact same thing. So what on earth happened?
That's the big question we're going to unpack here. How did this forbidden practice become the go-to move for pretty much every corporate giant on the planet?
So first, let's take a journey from outlaw practice to mainstream phenomenon. To really get this, you have to picture the world back in the early 20th century. The big idea in finance was this thing called capital maintenance, and it was simple, really. The money shareholders put into a company had to stay in the company, to protect the people the company owed money to. So buying back shares, that was seen as improperly giving that capital back. If a company had extra cash, the only real option was to pay a dividend. A buyback wasn't just a bad idea, it wasn't even on the menu.
Okay, so before we get into all the drama, let's just nail down what a buyback actually is. Because behind all the complex headlines, the idea itself is surprisingly simple.
At its heart, a share buyback is, well, it's exactly what it sounds like. A company takes its own cash, goes into the stock market, and buys its own shares. But, and this is the most important part, those shares are then basically retired. They're taken out of circulation, which shrinks the total number of shares out there.
So how is that different from a dividend? Well, think of it like this. A dividend is like cutting a pie and giving a slice to absolutely everyone at the table. Everybody gets some cash, but their ownership percentage, their piece of the pie, stays exactly the same. A buyback, on the other hand, is totally different. It offers cash only to the people who want to get up and leave the table. And for everyone who decides to stay, their slice of the pie just got bigger because the whole pie is now divided among fewer people. Your ownership gets concentrated. And it's kind of funny. Over 95% of all buybacks today follow this really simple three-step playbook. First, the board of directors gives it the green light. Second, the company starts buying up its shares on the open market, which can take months, sometimes even years. And finally, those shares get retired and the total supply shrinks. Simple as that.
So if this thing was forbidden for so long, what opened the floodgates? What were the key moments that unleashed this trillion-dollar boom?
For almost 100 years, that 188.7 UK ban was the standard around the world. But then, 1982 happened, and that was the game changer. The U.S. Securities and Exchange Commission introduced something called Rule 10b-18. It was a safe harbor rule that basically gave companies a legal playbook, protecting them from charges of market manipulation. That was the green light. It completely transformed American corporate finance, and eventually the rest of the world followed suit. And this whole boom was really driven by a perfect storm of three things. You had the new legal protection, you had some really powerful tax advantages, and then you had a brand new motivation for executives. See, CEO pay started getting tied to things like earnings per share, or EPS. And a buyback is a fantastic way to boost your EPS. You just reduce the number of shares, and poof, the earnings per share number goes up. It made buybacks an incredibly attractive tool for management. The tax angle was absolutely huge. I mean, in the US, for a long time, dividends were taxed right away as income. But with a buyback, investors only paid a capital gains tax if and when they decided to sell, and usually at a much lower rate. Or look at China. Dividends get taxed, but for individual investors, capital gains on A shares can be totally exempt. This kind of setup created a massive incentive for companies to choose buybacks over dividends.
Okay, so they became massively popular. But, and this is a big but, this rise to the top has been anything but quiet. The debate over whether buybacks are good, bad, or just plain ugly is one of the hottest arguments in all of finance.
Let's start with the good. The absolute strongest case for buybacks is that they're a powerful signal of confidence, right? When a company's own leadership team uses the company's cash to buy its own stock, they are basically shouting from the rooftops, hey, we think our shares are bargain right now. The best investment we can possibly make is in ourselves. And you want the poster child for this strategy? Look no further than the legendary company Teledyne. Under its brilliant CEO Henry Singleton, the company bought back a staggering 90% of its own stock. His thinking was just revolutionary for the time. Instead of just chasing growth for growth's sake,
He was obsessed with increasing the value per share. And for the shareholders who held on for the ride, the rewards were just astronomical. It is the textbook case of a perfectly executed buyback.
But then there's the other side of the coin. For every Teledyne, there's a much darker story, where buybacks are used not to create value, but for defense and even manipulation.
And this brings us to the ugly practice known as greenmail. Just imagine this. A corporate raider buys a huge chunk of a company and threatens to take it over. To make this problem just go away, the company's management agrees to buy back all of the raider's shares at a huge premium over the market price. Back in 1984, Walt Disney famously paid a raider a premium of over $70 million just to get him off their back. So the raider walks away with a massive payday, and who's left footing the bill? Yep, the regular shareholders who stuck around.
And the scale of these programs today is just hard to wrap your head around. $90 billion. Now, that wasn't the total for the entire stock market. That was the size of a single buyback program authorized by Apple in 2023. It just shows you how central, how massive this tool has become. Okay, so we've got the history, we've got the controversy. But with numbers that big, the real question is, why should you care about any of this? Well, the truth is, whether you're an investor, an employee, or just going about your day, this financial tool has a direct impact on your world.
If you're an investor, a buyback presents you with a very clear choice. If you sell your shares back to the company, great, you get cash in your pocket right away, but you give up on any future growth. But if you hold on, you don't get any cash, but your ownership stake in the company just automatically went up. Each share you own now represents a slightly bigger piece of the business.
But the impact goes way beyond just your portfolio. As an employee, maybe you get stock as part of your pay. Well, companies often use buybacks to soak up those extra shares so that the existing shareholders don't see their stakes get watered down. And as a citizen, this is where the huge economic debate really kicks in. Critics will argue that the trillions of dollars spent on buybacks could have been invested in R&D, used to pay higher wages, or put into long-term projects that benefit all of us.
And that really leaves us with the essential question, doesn't it? Are these buybacks a powerful engine for creating value, a way to reward shareholders and signal confidence? Or are they a short-sighted tactic, sacrificing tomorrow's innovation for a quick stock bump today? It's a debate that's still raging, and the final verdict is a long way from being written.